If I had cash sitting on the sidelines today, knowing what I know about this market, the panic that just rolled through it, and the way money tends to move when fear peaks before the headlines do, I would not be treating this like some moment to hide under the table. I would be doing almost the opposite. Because what matters right now is not whether the tape feels comfortable. It doesn't. What matters is whether the market is starting to tell you that the worst assumptions are being challenged, and whether the next leg is likely to reward people who were too cautious while everyone else was frozen. And by the way, it's Wednesday, April 15th in New York, so tell me in the comments what day and date you're watching this from. And if you value the way I break this stuff down, support the channel by subscribing and comment John A.G. Best, so I know you're here and you want more of these. Now here's the thing. A lot of people still think this market is only about fundamentals, only about valuation, only about reading a spreadsheet and waiting for the perfect entry. But that's not how this thing has been trading. The structure has been different. It's been faster, more violent, more headline-driven, more flow-driven, more technical, more reflexive. And that matters. Because when markets change character, the people using the old map keep walking straight into the swamp. What changed? Fear spiked. Energy spiked. Volatility jumped. People got defensive. Plenty of traders leaned the wrong way. Then the market stopped acting like it believed the worst case would last forever. That does not mean the risk vanished. It means price started saying, hang on a second, maybe the future is not as ugly as the present headline. And when that starts happening, you have to listen, because markets usually sniff out the turn before the crowd feels safe enough to admit it. That is why the conversation has shifted from hide in cash to start deploying cash. Not recklessly, not with both feet at once, not like some maniac on a sugar rush, but steadily, intentionally, on weakness. In the areas that still have room to catch up if this broad risk appetite keeps rebuilding. Now, I want to be clear. I'm not telling you to close your eyes and buy everything with a ticker. That's how people get clipped. I'm saying the tone has changed. And if you ignore that change because you're waiting for some perfect all-clear signal, you may miss the part of the move that actually pays. Based on recently published numbers, the Federal Reserve held rates steady in March in the mid-3% range, while the latest consumer price data still showed inflation running hotter than anyone wants. That's not a clean backdrop. It's messy. But messy does not automatically mean bearish. Sometimes messy just means selective. And that brings me to the heart of it. If this rally keeps going, leadership probably doesn't stay trapped in the same narrow handful of giant names forever. In fact, one of the healthier things you're seeing now is the possibility that leadership starts to widen out. And when leadership widens out, you don't have to be chained to the same crowded trade everybody has been hiding in. That's where the real opportunity begins. So where would I look first? Small caps. That would be near the top of the list for me. Not because they're magically immune to bad news, they aren't. They can be absolute drama queens. But because when the market starts leaning back toward growth, domestic resilience, falling fear, and improving liquidity expectations, smaller companies often move like they've been released from a cage. They don't need perfection. They just need the pressure to ease. And that's the setup people are trying to front run. Then I'd look at industrials. Why? Because industrials are where you often see the market vote for real economy endurance, not fantasy. Endurance. If investors start believing the economy bends but doesn't break, if capital spending keeps breathing, if supply chains settle a bit more, if infrastructure and manufacturing demand remain decent, industrial names can quietly keep grinding higher while everyone is still arguing on television about whether the sky is falling. Financials also deserve attention here. And I know a lot of people hear financials and immediately think, boring. But boring can make you money. Recent bank results have actually reinforced the idea that core activity hasn't rolled over the way the doom crowd wanted. Trading desks have been busy, deal flow has shown signs of life, consumer spending hasn't collapsed, and loan books have not suddenly turned into a horror movie. That doesn't mean banks are bulletproof. It does mean the picture has been sturdier than the panic suggested. Now let's talk about software, because this is where it gets interesting. Software has been one of those areas people loved when it was easy and hated when it got hard. You know how that goes. Everybody wants growth until growth gets repriced. Then suddenly nobody wants to touch it. But that emotional swing is exactly why software starts looking attractive when the dust settles. From recent market updates, the software trade has already shown signs of waking up, and the broad software ETF has bounced while still sitting well below where it used to trade. In other words, it's not fully loved again. That's important. The best contrarian setups usually don't begin when everybody is confident. They begin when people are still flinching. Would I blindly go load up on every software name? No, absolutely not. That's where I'd push back on the easy bullish story. Some of these companies are still proving they deserve the spending they've promised. Some are dealing with real questions about margins, competition, and what happens when artificial intelligence stops being a buzzword and starts becoming a price war. So yes, software can work, but this isn't a license to throw discipline in the trash. In my view, broad exposure first makes more sense than pretending you've discovered the one perfect name before the group has fully healed. And then there's international exposure. This one's trickier. I would not treat international like some giant, heroic one-way bet. Different regions have very different problems. Energy sensitivity is not the same everywhere. Currency pressure is not the same everywhere. Political risk is not the same everywhere. But when geopolitical stress hits, overseas markets often get punished fast, sometimes faster than the underlying fundamentals deserve. If diplomacy improves even a little and the pressure on oil cools, selected international exposure can catch a relief move that surprises people. We've already seen hints of that in Europe, where markets have been weighing earnings against the possibility of de-escalation. Here's another piece that matters. This rally has not been powered by one clean thing. It's not just fundamentals. It's not just technicals. It's not just short covering. It's not just earnings. It's all of it, layered together like some ugly market casserole. You've had fear come down, volatility cool off from the spike, software rebound, banks print solid numbers, and investors start entertaining the idea that maybe the economic engine has more life in it than they thought. You've also had plenty of people caught short. And when short sellers have to scramble, upside moves can look way stronger than the news alone would justify. That's why you can't just stare at a valuation chart and say, well, this should not be happening. The market does not care about your feelings. It cares about positioning, expectations, and where money is forced to move next. Now, does that mean straight up from here? No chance. I would expect pullbacks. I would expect ugly mornings. I would expect the kind of dips that make people question the whole thesis again. That's normal. In fact, that's healthy. A market that only levitates becomes fragile. A market that pauses, shakes out weak hands, and then finds buyers again is usually a lot more believable. So if you're sitting on cash, you don't need to marry one exact price. You can scale in. You can use red days. You can build, not lunge. And let me say something that a lot of people don't want to hear. Cash is not neutral when inflation is still running above comfort, and markets are repricing faster than your emotions can catch up. Cash feels safe because the number doesn't move. But the opportunity cost moves. The purchasing power moves. The market around it moves. According to the latest publicly available data, March consumer prices rose sharply on the month, and the annual pace stayed above the Fed's target by a wide enough margin to keep the policy debate messy. So yes, cash gives you optionality, but too much cash can quietly become its own bad trade. One more thing, I would not ignore gold here either, even if my main focus stays on equities. Gold has been acting like the market's pressure valve, which tells you big money still wants insurance while it leans back into risk. That is a useful signal. When stocks and gold can both attract flows at the same time, it usually means investors are optimistic, but not carefree. That's a very different backdrop from the kind of blind euphoria that ends badly. I'm not saying dump every bond and run into metal bars in your basement. I am saying the old assumption that safety only lives in fixed income has been under pressure for a while, especially when inflation keeps threatening to eat the coupon. So if you want defense, think smarter about defense. Don't just reach for whatever used to sound conservative in an older regime. Sometimes the safest looking thing on paper turns out to be the slowest way to lose ground. And that also supports the broader point. This is not just about chasing offense. It is about building a portfolio that can breathe if the market wobbles again hard. The inflation path is the big swing factor here. Near term, it may still look sticky. Energy has not exactly been behaving itself. The global backdrop is still tense. And the IMF is already warning that a prolonged energy shock would be a real problem for growth and for inflation. So anybody telling you the inflation issue is dead and buried is getting way ahead of themselves. That's the skeptical side of this story, and you should keep it in your pocket. But here's the other side. Markets do not wait for clean data. They anticipate direction. If traders increasingly believe oil pressure will ease rather than spiral, if they think diplomacy contains the worst-case scenario, if earnings stay firm enough, and if the Fed merely avoids turning more restrictive, risk assets can continue to climb even while the data still looks uncomfortable in the rearview mirror. That's the part a lot of people miss. Markets are not report cards. They are discounting machines. And on earnings, this is not some tiny footnote. This matters. Current estimates for broad U.S. earnings growth are still sitting in the double-digit range for the first quarter, and several big institutions have become more constructive on U.S. equities again, because profits have held up better than expected. You can argue that those expectations are too optimistic. Fine. That's a fair debate. But the point is, the market is not trading like it expects an immediate collapse in corporate America. Quite the opposite. So how would I handle this practically? First, I'd stop thinking in terms of all in or all out. That mindset ruins people. I'd think in terms of tranches, a little here, more on weakness, more if the thesis keeps confirming. That way you're participating without acting like you know the future with divine certainty. Second, I'd avoid being massively concentrated in one megacap corner of the market just because that worked before. There are moments when concentration pays. There are also moments when diversification finally has its day again. This could be one of those moments. Small caps, industrials, software, financials, and some measured international exposure all give you different ways to express a broader rally without simply hugging the same over-owned names. Third, I'd keep one eye on oil, one eye on volatility, and one eye on the dollar. Yes, that's 3 eyes. Work with me here. If oil starts screaming higher again, if volatility stops calming down and starts ripping, if the dollar abruptly tightens financial conditions all over again, the tone can change fast. That's not drama. That's just risk management. Fourth, I would not assume rate cuts are some magic fairy dust. This is where I disagree with the laziest bullish narrative. Lower rates can help, better liquidity can help, but if rates are coming down for the wrong reason, because growth is falling apart, that's a different movie. Right now, the more constructive case is that policy stays flexible, growth remains decent, and markets can work through an inflation wobble without a full-blown accident. But that's a conditional case, not a religious belief. If you're successful, share your success story in the comments so others can stay motivated. Now, could this market make new highs sooner than people expect? Yes, it could. We've already seen how quickly sentiment can flip once positioning gets caught offside. Could this year still end with very respectable returns even after all the panic? Yes, that's on the table too. The market has been a lot more durable than the headlines have made it look. Recent price action in small caps, software, and financials is a reminder that when money comes off the sidelines, it doesn't always wait for permission. But here is the line in the sand. If the conflict broadens materially, if more players get dragged in, if energy breaks higher again and stays there, if inflation reaccelerates in a way the market can't shrug off, then the whole sunny interpretation gets shaky fast. Then you pivot. Then you get more defensive. Then you stop pretending every dip is a gift. That's not being inconsistent. That's being an adult. So no, I don't think this is a moment to sit there frozen, polishing your cash pile while the market starts sniffing out a better path. I think this is a moment to get serious, get selective, and start putting money to work with a plan. Not because fear is gone. Fear is not gone. But because when fear begins to lose control of price, opportunity usually walks in through the side door. That's how I see it right now. Stay flexible, stay humble, and let the market confirm itself. Use this to sharpen your own thinking, do your own homework, and make decisions that fit your own risk tolerance. Because this is education, not personal financial advice. And the market has a beautiful way of humbling anybody who forgets that.